Mortgage insurance, what is it? Why do we need it? And when does it come into play? Let's talk about it. Hey guys, video 9 today is about mortgage insurance. Before we get started, I want to give a couple definitions, just in case there's somebody watching, which there probably is, that isn't in the real estate world or in the mortgage world. I wanted to give two definitions. One is PMI. You might hear me say PMI a lot. P as in Paul. Excuse me. That's private mortgage insurance. That's just regular mortgage insurance. That's the topic of the video, but that's the acronym that we use most often here in the mortgage world. Also, you'll hear me say LTV, or loan to value. What that is a percentage of your loan amount to the value of your property. Also, it's the inverse of the down payment. So if you have 20% down, you have an 80% loan to value. If you have 5% down, you have a 95% loan to value. So you might hear me say LTV a little bit, and just wanted to get those definitions out there just in case you needed them. Okay guys, let's talk about what exactly mortgage insurance is. Basically, mortgage insurance is ensuring the bank they're never upside down on your mortgage loan. Okay, so in the event that a foreclosure has to happen, mortgage insurance comes into play if there's a difference in the loan balance and the value of the home that they repossess. If the loan balance is higher than the value of the home they repossess, mortgage insurance steps in and covers that gap. Okay, so that's what it is in a nutshell. There are lots of different attributes to mortgage insurance, but in a small, concise term, that is what it covers. That shortage, if there ever happened to be some, that covers that shortage in your loan balance and the value of the home if there's ever a repossession. I want to touch just really briefly here on cost. The cost of your mortgage insurance is not, like we talked about yesterday, it's not a state rate. It's not, if the loan amount is this big, then the mortgage insurance is this much. It has to do with much more than that. It has to do with how much money you're putting down originally. It has to do with your credit score. It has to do with your DTI. It has to do with your loan to value. It has to do with all of those different scenarios that are in your individual mortgage application, and that's how they determine the premium for your mortgage insurance. So make sure that your lender is looking at all of the options he has available, because most of the time the different mortgage insurance companies have the same rate for the same scenario. I have seen a couple times where one company has a lower rate for the same scenario, and it doesn't matter which company you get it from, as long as your lender has availability to that company. So make sure that your lender is checking across all of his options and to get you the best premium for the mortgage insurance. Okay guys, let's talk about when mortgage insurance is put in place. Mortgage insurance is put in place on any loan that has less than an 80% loan to value. If you remember from the definitions at the beginning of the video, that means, in other words, that means if someone puts less than 20% down on a loan, mortgage insurance is required, okay? Mortgage insurance rates and terms differ based on the different types of loan programs. Real quickly, we're going to talk about them in this order. We're going to talk about VA loans, we're going to talk about conventional loans, we're going to talk about FHA loans. Real quick, right off the top, VA loans, there is no mortgage insurance on a VA loan. However, there is a funding fee, which adds a little bit more of a cost, but just right off the bat, let's get that one out of the way. VA loans do not have mortgage insurance, but they do have that extra required funding fee at closing. Conventional loans have mortgage insurance required on their loans until that loan reaches a loan to value of 78%. Now, real quick, just a small note on that. That could be through the reduction of your loan principal, okay? Through the reduction, as you make payments, your loan balance comes down. That could also be in the increase of the value of your home, okay? So if there was a period of time where you bought and now you think your property is worth a lot more than it was, you can refinance that property or get another appraisal and try to get the PMI removed that way, okay? Okay, lastly, let's talk about FHA loans. FHA loans and mortgage insurance is kind of complicated, but it doesn't have to be. Let's just remember this. It's dependent upon one thing. It's dependent upon how much you put down originally, okay? Mortgage insurance on an FHA loan goes like this. If you put down less than 10% originally, so when you do the loan at the very beginning, when the loan is originated, when you take that loan out, if you put less than 10% down on an FHA loan, mortgage insurance stays on there for the life of the loan. Okay? That means until you pay it off and sell that house, or you refinance it into a conventional or some other product that doesn't have the FHA PMI on it, okay? If you put down more than 10% on your mortgage, on your FHA mortgage loan originally, it stays on there for about 11 years. Quick side note, the average age of a mortgage right now is 7 to 8 years. So 11 years is effectively the life of that loan. Okay guys, that's it. Signing off here from my office in Fort Worth. Had to come up here and get a little bit of work done, but wanted to make sure that I got you some information on mortgage insurance first. If you have any questions or comments, please leave them down below. I'll do my best to answer those as promptly as possible. You guys have a great day, and we'll talk soon. Oh, hello. Didn't see you there. Welcome to my office.